President Biden was in Chicago promoting what the White House is referring to as Bidenomics. His address comes as several economic indicators seem to point in the positive direction. One key indicator, the Conference Board's Consumer Confidence Index, jumped more than 7 points from May. That is the highest in more than a year, and Biden kept that upbeat tone.
Bidenomics is about building an economy from the middle out and the bottom up, not the top down. And there are three fundamental changes that we decided to make with the help of the Congress. We've been able to do it. First, making smart investments in America. Second, educating and empowering American workers to grow the middle class. And third, promoting competition to lower costs to help small businesses.
Federal Reserve Chairman Jerome Powell joined central bank presidents from the ECB, the UK, Japan at a forum to discuss the recent global monetary policy. In Portugal, the central bankers reaffirmed that further policy tightening would still be needed to combat the high inflation. They believe this can be achieved without triggering an outright recession. Powell is keeping more rate hikes on the table after pausing them just in June. He clarified this with the following.
We've not decided that. So the only thing we decided was not to raise rates at the June meeting. We have not made a decision to go to that. It may work out that way. It may not work out that way, but I wouldn't take, moving at consecutive meetings off the table at all. If you look at the data over the last quarter, what you see is stronger than expected growth, a tighter than expected labor market, and higher than expected inflation. So that tells us that although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough.
Here's a quick look at how U.S. markets reacted to those headlines. John Terrett from the New York Stock Exchange.
After the closing bell, Micron, one of the big microchip makers in America, gave us its latest set of earnings. Its loss was $1.43. Its revenue was a beat, and in the gray market, after the main market closed, Micron shares were ahead by between 4 and 5%. Micron has some headwinds, though, because China has let it be known it doesn't want Chinese company buying its microchips in the future. But Micron is going ahead with investment in China, bringing many new jobs to the country. So it is a very interesting situation. Caught up, I think, in the sort of mini war that's going on between Washington and Beijing over the future of microchip production. On the main markets, the dominant theme was recession and interest rates and inflation. Chairman Powell didn't help when he spoke in Europe and said we didn't think we'd get back to 2% inflation in this country either this year or next. And Bidenomics was introduced in Chicago with a major speech by the president in which he also introduced billions of more dollars for infrastructure. So the Dow was down by between 1/5 and 1/4 of 1%, 73 points. NASDAQ was up by about the same amount, 36 points. S&P 500 was flat at 43.76. And on the crypto front, Bitcoin down 2%, Ethereum 3%, and XRP 2.3%. On Thursday, earnings come from Nike, which does a lot of work in China, as you know. We get the weekly jobless numbers, which we always do on a Thursday, and we get a revised look at U.S. GDP or growth. All of that later on Thursday. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
For more on how to make money, we're joined by Thomas Hayes, founder, chairman, managing member of Great Hill Capital. Good to see you. The last few weeks, I will say I am perplexed because we had the non-rate hike, then we had the talk of more rate hikes later. The market doesn't give a damn. It's been rallying almost every day. We're near new highs. The real estate market's rallying. Tech stocks are rallying, albeit a very small pullback. But it seems to me that investors are looking well beyond what 2 rate hikes are going to be. Is that a mistake?
Well, the 2 rate hikes are likely not going to happen. Thanks for having me, Phil. The economic data continues to blow by expectations, as you pointed out, with the Consumer Confidence Board. Consumer confidence is the highest it's been in 15 months now. You saw building permits higher than expected, up 5.6% yesterday relative to negative 1.4 last month. You saw new home sales up 12.2. People are just getting on with their lives. And the thing that Powell said is he can remain restrictive just by keeping the Fed funds rate elevated for a period of time. So, he basically said the market can go up, the market can go down. We may do two months, we may do 0 months. All we did was pause. So I think what he's trying to do is talk hawkish, act dovish, because he knows what most astute market watchers know, which is owner's equivalent rent this month is going to come in very low. It works on an 18-month lag. It deals with the deceleration in the increase in home prices 18 months later. And that's about over a third of CPI, headline CPI. So if that's a live meeting, we get a weak headline number, mid threes to low threes. I think they skip again, and that skip turns into a pause. That doesn't mean they're going to start cutting. They're going to remain restrictive probably through the end of the year, if not beyond.
The last couple of hours, we got these test results in from the bank stress tests, which I was a little surprised. They all passed. It seemed to me, I guess, if it was bad news, maybe they don't release the results, but it seemed to be good news. But these bank stocks, and I know you like a couple of them. I think you mentioned Bank of America in the past. They haven't done a darn thing for the last couple of months. Is it time they join the rally too?
Yes, and that will happen after the end of the month. No one's going to change their positioning before they print the end of the month. I think that theme for the second half is going to be those stocks that have underperformed on a relative basis in the first half. So we had the Magnificent Seven up until about a month ago. They drove most of the gains. 90% of the bottom of the S&P 500 in aggregate were up 0%, even though the S&P was up double digits. I think that's going to shift in the second half as the dollar continues to weaken with the Fed out of the way. As bonds start to get bid and rates get compressed, you're going to get a benefit, major benefit. I think REITs are a place to be. I think banks are a place to be. And I think as a result of banks being a place to be, small caps are going to start to outperform on a relative basis.
We had some news out of Delta.
Yeah.
I think it was a day or two ago. And these airline stocks, they also haven't done a ton either. The airline stocks are moving. The travel stocks are moving. And what Delta, their CEO, basically said was that this jump in demand that we're seeing for travel, it's here to stay. And it might get even stronger. I mean, if that doesn't make you optimistic, I don't know what will. But these airline stocks are still very much hammered from when we had the pandemic. Most of them are still trading at, 30 or 40 cents from where they were.
Yeah, well, the only sector that was almost as hated as tech was at the end of last year when we were pounding the table with you, let's go, it's time to buy tech, was consumer discretionary. And what we're seeing is that the consumer has jobs, and so long as the American consumer has jobs, they like to spend money. They bought everything off of Amazon when they were locked up in their house during COVID. Now they want to get out and experience the world. They realize life is short. It's time to get on with living. You're seeing the cruise stocks. You're seeing the airline stocks. The key with that is you got to just look at them on a one-by-one basis and look at their balance sheets, make sure they're not too over-levered and have too much debt to refinance at higher rates. But beyond that, the theme is up.
Well, look, we're going to get earnings, I believe, from Nike in the next day or so. And we should get a very good gauge of how healthy or unhealthy the U.S. consumer is, because we hear from experts the recessions are coming, inflation's killing everybody, and things are terrible, and there's layoffs. But then there's this whole flip side of the news that you watch, that things are strong, unemployment is low, people are buying houses, and people want to spend, I guess, $200 on Lululemon or Nike T-shirts. I don't know where they're getting this money from, but there's something odd going on here with the consumer.
Well, Nike's going to be as much of a story about the U.S. consumer as it's going to be about the Chinese consumer. And what we're seeing from the 618 holiday was that the volumes were pretty good. The Chinese consumer is slowly coming back. Keep in mind, you've only been unlocked from COVID-0 for about less than half a year, and that consumer is rebuilding confidence. The economy is rebuilding confidence. Market participants are expecting there should be some meaningful stimulus in the back half of the year. So I think Nike will be an interesting tell on the U.S. consumer, but a more interesting tell on the Chinese recovery. So we're looking forward to that report.
We're getting to my favorite part of this the show with you, and that's when everybody gets their piece of paper and pencil out, because I'm going to ask you for 3 stock picks in 30 seconds. What do you got for us for the end of June?
Oh my goodness, 30 seconds. So you don't want to know why to buy them. You just want to know what to buy. Well, I'll tell you what we own, and you can do your own homework. Number 1 is PayPal. This one is completely left for dead. People think the competition from Apple Pay is going to be dangerous, or the Fed now. The bottom line is they get 50% of their revenues abroad, so that weakening dollar is going to help them. They're trading at a third of their normal multiple, 11 times earnings versus over 30 times historic. They're going to have a replacement of their CEO before the end of the year. That will be a catalyst when you have Elliott Management in the stock. Generac, the most boring stock, 75% of the market for home standby generators. They were left for dead because they overstocked during COVID. That inventory troughed in the first quarter. They're starting to work through that. You're seeing the stock is up meaningfully. We started talking about it at around $101. It's up to $148. We think that's got another $100 in it over the next 12 to 24 months. So we like that. And then, of course, we love our emerging markets. We just got to get past this end of the month, get the Fed out of the way, dollar weakens, emerging markets, China is a buy.
Tom, good to see you, my friend.
As always, thanks so much.